There are weeks in the market that are easy to ignore, and then there are weeks like this one. Over the next few days, 5 of the most important companies in the world are reporting earnings. The Federal Reserve is making a rate decision, and the market itself is sitting at a level that will tell us a lot about where the rest of this year is headed. We're going to take all of that seriously today. No shortcuts, no noise. Just a grounded, careful look at what the data is actually saying. By the time we're done, you'll have a clear read on the macro setup, a realistic take on what the Fed is likely to signal, and a stock-by-stock breakdown of Microsoft, Meta, Alphabet, Amazon, and Apple heading into earnings. If you get value from this kind of analysis, subscribe to Finance Hype right now. It takes 2 seconds, and you won't miss a breakdown like this one. Let's get into it. Here's where the broader market stands. The S&P 500 recently pushed through a resistance level that had been holding it back for several sessions in a row. That alone was worth noting. But what happened next is what really matters. On the first meaningful pullback after that breakout, the index came right back down to test that same level, and it held. In technical analysis, that's called a successful retest. Old resistance becomes new support. It's one of the cleaner signals you can observe on a chart, and what it tells you is that institutional investors are buying into dips, not selling into them. The market then bounced off that level and pushed back toward all-time high territory. That is a structurally healthy sequence. On the technology and growth side, the story is similar. That index actually led the breakout slightly ahead of the broader market, which is typically a positive signal. When large institutional money gets confident about earnings and the economic outlook, growth stocks tend to move first. That's what we're seeing. Small caps are mixed. A few cyclical sectors are seeing some modest selling. Those are normal divergences in a maturing rally. They don't change the primary trend. One thing worth flagging: crude oil has moved higher this week. Both Brent and WTI are up, driven largely by geopolitical tension. Rising energy costs create real headwinds for logistics, retail, and consumer-facing companies, while benefiting names in the energy sector. This isn't a reason to panic. It's a reason to be precise about where you have exposure. Let's talk about the Federal Reserve, because this matters a lot this week. The FOMC meeting is expected to produce no change to the federal funds rate, which currently sits at 3.75%. That's the consensus, and futures pricing reflects it. For most investors, a hold is a neutral to positive outcome. It removes uncertainty, it preserves predictability, and markets tend to reward predictability. Here's the thing most people miss, though. The rate decision itself is rarely the market-moving event. What actually moves markets is the press conference that follows. You want to pay attention to 3 things specifically. First, how does the chair characterize inflation? Are they expressing confidence that it's on a sustained path toward target, or are they still hedging? Second, what language are they using around future rate cuts? Is the door open, or is it closing? And third, what's their read on the labor market and economic growth? A resilient economy tends to translate into a more patient, hawkish posture. A hawkish tone, one that emphasizes higher for longer, would likely create near-term pressure on growth stocks. A neutral or dovish tone gives the market room to keep moving. There's also a longer arc consideration worth noting. The current Fed leadership era is approaching its end. Markets are already beginning to price in expectations that incoming leadership may take a more accommodative approach, meaning greater openness to rate cuts over time. Markets are forward-looking by nature. They move on expectations, not just current reality. If that expectation solidifies around new leadership, you may see it reflected in stock prices before any actual policy shift occurs. All right, 5 stocks. Before we go through each one, the standard and important reminder: this is analysis, not financial advice. Your situation is unique to you, your time horizon, your risk tolerance, your goals. Treat this as a framework for your own thinking, not a blueprint to follow blindly. First, Microsoft, ticker MSFT. Let's be straightforward about this one. Microsoft has been one of the softer performers among mega-cap tech over the past several months. Software as a category has faced genuine headwinds, and there's been real uncertainty around the revenue contribution of its AI partnerships, particularly with OpenAI. The stock corrected sharply from its highs. In recent weeks, though, the price action has started to shift. Microsoft has crossed back above both of its primary moving averages for the first time in a sustained period. That tends to attract systematic buying, and it's a development worth taking seriously. That said, One technical crossover doesn't confirm a trend reversal. For the chart to genuinely break out of its intermediate downtrend, Microsoft needs to reclaim and hold above the 450 to 475 range, with 500 as the next meaningful level of significance. Until that happens, each rally carries the risk of being a retracement, not the start of a new leg higher. On the earnings side, analysts are projecting EPS of around 460 compared to 346 last year. Revenue is estimated at about $81.4 billion versus $70 billion in the prior year. That's roughly 16% year-over-year revenue growth, solid by most standards. But in an environment where software sentiment is still fragile, a miss or soft guidance could undercut the recent technical improvement quickly. Drop a comment below right now. Do you currently hold Microsoft, and are you expecting a beat this quarter? I genuinely want to know where this community stands heading into the print. Second, Meta platforms, ticker Meta. Meta's chart over the past couple of months tells a very clear story. The stock sold off hard, created real fear in the market, and then staged a V-shaped recovery of approximately 30% off the lows. Recoveries of that magnitude and speed don't happen without deliberate institutional buying. Large capital was deployed into that weakness, and that matters for how you interpret everything that follows. Right now, Meta is contending with a resistance zone in the $697 to $700 range. That level has capped the stock on multiple prior occasions. A clean, high-volume break above it, on the back of a strong earnings report, would be technically significant, and it could set up a run toward the mid-700s in the near term. The intermediate pattern resembles what analysts call a cup and handle, a rounded base, followed by a consolidation that, if resolved to the upside, tends to produce sustained directional moves. On the fundamentals, the picture is genuinely strong. Revenue for this quarter is estimated at approximately $55.5 billion compared to $42.3 billion last year. That's year-over-year top-line growth of over 30%. For a company at this scale, that's remarkable. EPS is projected at around $6.65. The advertising business remains robust. AI integration is accelerating across platforms. Core user engagement has held up. If Meta delivers and breaks through that 700 ceiling, the path to the mid-700s opens meaningfully. The case for $800 to $1,000 per share over the next 2 to 3 years is not an extreme position given this revenue trajectory. Third, Alphabet. Most people know it as Google. Ticker, Google. Of the 5 stocks we're covering today, Alphabet has arguably the most constructive near-term technical setup. The chart has been forming an ascending triangle over an intermediate time frame, higher lows converging toward a flat resistance ceiling. When these patterns break to the upside with volume confirmation, they tend to produce meaningful, sustained moves. We're beginning to see that breakout initiate. Alphabet is pressing through the 345 to 350 resistance zone, and analyst price targets are building toward a near-term test of $400 per share. If you look at the Alphabet and Microsoft charts side by side, the contrast is instructive. Alphabet is actively breaking out of a consolidation. Microsoft is still in the early stages of proving a reversal. For investors focused on near-term positioning, that distinction is meaningful. On the fundamentals, Alphabet is expected to report revenue of approximately $89.5 to $90 billion against around $80 billion in the prior year. That's growth in the 18 to 19% range. For a company approaching a $4 trillion market cap, sustaining that growth rate is genuinely extraordinary. EPS is projected at approximately $2.63, compared to $1.89 last year, a significant year-over-year increase. Google Cloud is accelerating. AI integration across search and other products is deepening. The core advertising business remains dominant. The fundamental story here is strong, and the chart is confirming it. Fourth, Amazon. Ticker AMZN. Amazon has been one of the stronger recovery stories in the market over the past several weeks. After a sharp sell-off, the stock found a floor, and since then, it's climbed more than 30%, pushing into all-time high territory. That kind of sustained recovery reflects genuine institutional conviction. Amazon runs on 2 distinct engines. The first is the retail and e-commerce platform that most American households interact with every day. The second, and far more important for valuation, is Amazon Web Services. AWS is one of the highest margin, fastest growing business segments in all of technology. Cloud infrastructure is foundational to the modern digital economy, and Amazon holds a leading market share position in that space. In the most recent earnings report, AWS came in meaningfully ahead of expectations. That positive surprise triggered significant buying. The central question for this week's print is whether that cloud momentum has continued. Revenue estimates are approximately $177 billion, compared to $155.6 billion last year, growth of around 14% year over year. EPS is projected at roughly 1.65 versus 1.59 last year. If AWS delivers again, and if management sounds confident about the cloud growth trajectory, the path to $300 per share this year is a legitimate scenario. That's a statement worth taking seriously. And fifth, Apple. Ticker AAPL. Apple is the most complicated conversation of the five, not because the business is in question, but because the near-term technical setup is the weakest of the group. The stock has been forming a descending triangle, lower highs pressing against a relatively stable floor. Descending triangles tend to resolve to the downside absent a meaningful positive catalyst, and we're seeing some pressure on the stock this week as well. Here's the counter-argument, and it's a real one. Apple has a unique ability to generate positive surprise in ways that very few companies can replicate. A credible advancement in agentic AI through Siri, a confirmed foldable iPhone launch, an entirely new product category. Any of those things can send this stock sharply higher, regardless of what the chart pattern is suggesting. Apple has done it before, and the installed base of over 1 billion active devices gives them a distribution advantage that is nearly impossible for competitors to replicate. On the numbers, revenue is estimated at approximately $109.7 billion versus $95.4 billion last year. That's around 15% year-over-year growth. EPS is projected at 1.95 compared to 1.53 last year. Solid numbers for a business generating this level of cash flow. Here's the honest takeaway on Apple. For investors thinking in 3, 5, or 10-year horizons, the near-term chart setup is a smaller piece of the calculus. Apple has demonstrated repeatedly the ability to navigate downturns, macro headwinds, and competitive pressure. The long-term thesis remains intact. For shorter-term traders, the technical setup warrants patience. Know which one you are before you act. Let's pull it all together. This week presents an unusually concentrated set of market-moving events. 5 of the most important companies in the global economy reporting earnings. A Federal Reserve decision with a press conference that will be parsed at every level of the financial world, and a market that recently broke to all-time highs and is in the process of proving whether that move has real follow-through. The trap that a lot of investors fall into in weeks like this is overreacting to each incremental data point. A strong earnings report becomes a reason to chase. A soft print becomes a reason to sell everything. That reactive loop is costly over time. The more useful approach is to have a clear thesis before the data arrives, and then evaluate the data against that thesis, rather than being driven by it. The investors who build real wealth over time share one common characteristic: process over reaction. They know what they own and why. They have defined levels at which they'd add or reduce exposure. They take profits when positions get extended. And they have the patience to wait for genuinely favorable setups, rather than chasing momentum after a move is already well underway. A week like this one, full of data, headlines, and noise, is exactly where that discipline gets tested, and exactly where its value becomes most apparent. That's the full breakdown for this week. The macro setup is constructive. The Fed outcome is likely a hold, with the press conference carrying the real information. On the stock side, Meta and Alphabet have the most compelling near-term technical setups. Amazon's recovery is real, but it hinges on AWS execution. Microsoft is showing early signs of reversal, but needs follow-through above 450. And Apple is a long-term conviction name with a near-term chart that calls for patience. As always, this is analysis, not advice. Do the work. Understand what you own. Make decisions calibrated to your own situation. If this breakdown helped you think more clearly about what's happening in the market this week, hit the like button. It genuinely helps other serious investors find this content. And leave a comment below. Which of these 5 stocks are you most focused on heading into earnings? Microsoft, Meta, Alphabet, Amazon, or Apple? I read every comment, and the conversation in this community is always worth the time. Subscribe to Finance Hype if you're not already with us. We do this kind of structured, grounded analysis every single week, and you do not want to miss what's coming next. We'll see you in the next one.